Borrow Smart segment today. That's what we're going to chat about. Understanding mortgage rates. Why you're seeing different rates. Why is it that I just shared with you that the 30-year fixed rate is 6.478? There are a few lenders that will actually use numbers like that. Most of the lenders are going out, and banks will call it either 6.5 or 6 3/8. There are some lenders that actually will do 6.47. Okay, they just like to use it as a little bit of a ploy. But let's understand mortgage rates, why you're seeing different numbers. When shopping for a mortgage, you've probably come across a common scenario. The news reports a national mortgage rate of 6.5%. We're just using round numbers. But when you receive a quote, the rate is closer to 7%. It's a discrepancy that leaves many potential homeowners scratching their heads. Understanding why this happens involves delving into the nuances of mortgage rates, how they're reported, and what factors influence the rate you're ultimately offered. So let's look at the basics of mortgage rates. Mortgage rates are the percentage of interest charged on a home loan. These rates are influenced by various factors, including the borrower's credit score, loan amount, down payment, and the type of loan. The rates you see reported in the media are often average rates based on ideal borrower scenarios and may not reflect the rate you'll receive based on your unique financial situation. Why is the rate you see isn't the rate you get? The mortgage rates reported in the news are typically based on national averages or the lowest rates available under optimal conditions. These conditions assume a borrower with an excellent credit score, a substantial down payment, and a standard 30-year fixed rate mortgage. However, most borrowers don't fit this perfect profile. Here's why the rate you're quoted may be higher. Number one, credit score. Lenders assess your credit worthiness by reviewing your credit score. Borrowers with higher credit scores are viewed as less risky and therefore are offered lower rates. Conversely, if your credit score is lower, lenders may charge a higher rate to compensate for the perceived risk. Loan to value, acronym LTV. The LTV ratio compares the loan amount to the appraised value of the property. A lower LTV ratio, meaning you're putting down a larger down payment, typically results in a lower interest rate because the lender is taking on less risk. Number three, loan amount and type. Jumbo loans, loans that exceed the conforming loan limits set by Freddie Mac and Fannie Mae, often carry higher interest rates due to the increased risk to the lender. Similarly, adjustable rate mortgages, known as ARMs, might have a lower initial rate that could increase over time, while fixed rate mortgages lock in a rate for the duration of the loan. Number four, points and fees. The rates advertised by lenders or in the news often assume that you'll pay discount points to lower your rate. A discount point is a fee paid up front to reduce the interest rate, with 1 point typically costing 1% of the loan amount. Without paying these points, your quoted rate will be higher. So what is the role of discount points? Discount points allow you to buy down your interest rate by paying a portion of the interest up front. For example, if you have the option to pay 1 point, which is 1% of the loan amount, to reduce your interest rate by 0.25%, you must evaluate whether the upfront cost is worth the long-term savings. The decision to pay points depends on factors like how long you plan to stay in the home and your cash flow needs. So here's a scenario. If the national rate is 6.5% and you're quoted 7%, part of the difference might be that 6.5% assumes you're paying points. If you choose not to pay points up front, your rate could be closer to 7%. Let's understand rate locks and market fluctuations. Mortgage rates fluctuate constantly due to changes in the financial markets. Economic indicators such as inflation, employment rates, and the Federal Reserve policies all impact mortgage rates. This volatility means that the rate quoted to you on one day might change by the time you're ready to lock in your loan. That could be the same day, it might be different, or another day. When you receive a mortgage quote, it's important to understand whether the rate is locked or floating. A rate lock guarantees the rate for a specific period, typically 35, 40, or 60 days. If you lock in your rate, you're protected from increases during the lock period. However, if rates drop, you may miss out on a lower rate unless your lender offers a float down option, which allows you to take advantage of a lower rate if the market improves before closing. Comparing quotes and the importance of APR. When comparing mortgage quotes, it's essential to look beyond the interest rate and consider the annual percentage rate known as the APR. The APR includes both interest rates and any points or fees giving you a more accurate picture of the total cost of the loan over time. For example, two lenders might offer the same interest rate, but if one lender charges higher fees, the APR will be higher. The APR is a valuable tool when comparing loans because it reflects the true cost of borrowing, including all associated expenses. The impact of economic conditions. Economic conditions play a significant role in determining mortgage rates. For example, when the Federal Reserve raises interest rates to combat inflation, mortgage rates often rise in response. Conversely, during economic downturns, the Fed may lower rates to stimulate borrowing, leading to lower mortgage rates. The Federal Reserve does not control mortgage rates, but they help with the conditions. It's also important to consider the broader economic outlook when deciding on a mortgage. If experts predict that rates will rise in the future, locking in a new rate now might be beneficial. On the other hand, if rates are expected to drop, you might consider an adjustable rate mortgage or plan to refinance later. How lenders tailor rates to your financial picture? When you apply for a mortgage, lenders assess your financial situation to determine the appropriate interest rate. These assessments include reviewing your credit history, income, debts, and assets. Lenders use this information to gauge your ability to repay the loan and to set a rate that reflects the level of risk they're taking on. Another example, a borrower with a stable job, low debt-to-income ratio, solid savings accounts likely to receive a lower interest rate than someone with fluctuating income and higher debt levels. Lenders also consider the type of property being financed. Primary residences typically qualify for lower rates than investment properties or second homes, as lenders view owner-occupied homes as less risky. Refinancing, planning for the future. One strategy that many borrowers overlook is the potential to refinance their mortgage in the future. If you're concerned about being quoted a higher rate today, it's worth considering whether refinancing might be an option down the line. For instance, if rates are projected to drop in the next 12 to 24 months, you might opt for a mortgage that minimizes upfront costs, knowing your plan to refinance when rates decrease. Some lenders will offer no-cost refinancing options, which allow you to refinance without paying new closing costs, making it easier to take advantage of lower rates in the future. Again, working with a mortgage professional, navigating the complexities of mortgage rates can be overwhelming, which is why it's crucial to work with a knowledgeable mortgage professional. They can provide personal advice based on your financial situation, helping you understand the full picture, not just the rate. Your mortgage professional can also guide you through scenarios that compares different rates and terms, helping you see how factors like paying points, adjusting the loan term, or choosing an ARM. Remember our famous safety, liquidity, and return concept? How it all impacts your overall cost. Moreover, a mortgage professional can offer insights into market trends, helping you decide whether to lock in a rate now or wait for potential changes. Their expertise ensures that you're not just getting a good rate, but the right rate for your unique situation and circumstances. Bottom line, making informed decisions, the mortgage rate you quoted is more than just a number. It's a reflection of your financial profile, the type of loan you're seeking, the current economic environment. While it's easy to focus on headline rates, it's essential to consider the full scope of factors that influence your rate. By understanding why your rate might differ from the one you see in the news, you can make informed decisions that align with your financial goals, whether you're buying your first home or refinancing an existing mortgage. Work with a trusted mortgage professional ensures that you're not just getting a competitive rate, but the best possible mortgage for your needs. In the end, the goal is to secure a mortgage that supports your financial well-being, both now and in the future. With the right guidance, you can navigate the complexities of mortgage rates and confidently move forward on your path to home ownership. That is the Borrow Smart segment, brought to you by rsrhomeselect.com, rsrhomeselect.com.